Was Deutsche Bank just the beginning? Let's have a look. Hello everyone, Florian Heiser here and welcome to another episode of Heiser Says. I hope you've had a good lunchtime. I've got my stein of coffee, just had a nice steak, and I thought we'd read through this article that came out a few days ago regarding the Deutsche Bank, shall we say, retrenchment or sacking of 18,000 people, predicting that this is just the beginning. So let's have a look. This is a columnist from Callan Maley from the Australian Financial Review. So financial markets have been sent reeling after Deutsche Bank unveiled the biggest restructuring plan in its history, but it's unlikely to be long before other major banks follow suit. Germany's banking giant, which will celebrate its 150th anniversary next year, is planning to sack 18,000 people, or around 1/5 of its workforce. Well, it has, and create a bad bank to house 74 billion of risky assets, including long-term derivatives, in an attempt to escape its financial woes. So this is one hell of a restructuring, isn't it? More importantly, Deutsche Bank is abandoning its global ambitions as it retreats to its more traditional banking activities. It will close its unprofitable equities trading business and shrink its bonds and rate trading operations. Instead, it will focus on bread and butter domestic retail banking and providing corporate finance for German and European companies. I wonder how Brexit is going to affect that. I wonder. Of course, Deutsche Bank had little choice but to undergo a radical overhaul after negotiations for a merger with its competitor, Commerzbank, collapsed over 2 months ago. Interesting. The merger plan, which many believed was tantamount to a bailout, was strongly backed by the German government. The government was worried that Deutsche Bank, which plays a crucial role in financing the German economy, could become a takeover target for a foreign competitor. Deutsche Bank's share price has tumbled 25% in the past year, leaving the bank with a market capitalization of less than 15 billion on Friday. But Deutsche Bank's woes reflect more than its failed strategy to transform itself into a global trading powerhouse, capable of taking on the big US investment banks like Goldman Sachs. They're symptomatic of the broader malaise among European banks, which have endured years of ultra-low interest rates and sluggish growth. German bankers in particular have long grumbled that their profitability has been undermined by the European Central Bank's ultra-easy monetary policy, including negative interest rates on central bank deposits. What's more, the ECB's massive $2.6 trillion bond buying program, which was halted in December but looks set to be revived in coming months, has pushed the yield on benchmark German 10-year bonds down to minus 0.36%. Okay, now this was interesting because with the post I did yesterday looking at just the stock market and the bond values here in Australia, some people were mentioning that if, say, maybe our RBA, Reserve Bank, was to do some quantitative easing, the method they would do that would be through a bond buyback program where they'd be buying up bonds to get more money into the economy. Now, the ECB, has been doing that, obviously, or looks like it, the European Central Bank. And it's interesting just to see the flow-on effects of all of this. The negative interest rates and just the profitability of this business and the number of jobs they've had to cut. And, it's I think, valuable to have this perspective, or have this information and think about it from an Australian perspective, how it would affect our Big Four. Although I doubt that, I don't know, if someone let me know, are our Big Four competing at the same level? I would imagine they're not. The collapse in long-term bond yields is bad news for banks, which traditionally earn a margin by borrowing short-term and lending long-term. Even worse for the country's banking system, Germany, which accounts for close to 1/3 of all economic activity in the Eurozone, has seen growth battered as slowing global trade has sapped demand for German exports. As a result, the German economy expanded by an anemic 0.7% in the 12 months through to March. That's not looking good, is it? That's not looking good at all. So, faced with this double whammy of ultra-low risk rates and weak demand for new loans, German banks have turned their attention to cutting costs. Last year, the German banking sector shed more than 32,000 jobs. Wow, or around 5.4% of its workforce. Well, there you go. There you go. As the ECB prepares to unveil fresh stimulus, more banks are likely to follow Deutsche Bank's lead in overhauling their operations. Oh, what? So free money doesn't come without problems, does it? I really wonder if Brexit will happen. I really do. They must be rushing to get out of there. In its latest annual report, the Bank for International Settlements warned that the profitability of banks has been lackluster. According to the BIS, which is known as the Central Bankers' Bank, this is because persistent low interest rates have narrowed the gap between short and long-term interest rates, known as the yield curve, and this in turn has depressed banks' interest rate margin. At the same time, weak economic growth has reduced the volume of new bank lending and led to a rise in the share of troubled loans on banks' books. The BIS warned that should economic activity deteriorate and interest rates remain low, banks' profitability could come under further pressure. The BIS also warned that bankers face a tough battle ahead as they try to rebuild their profitability. Costs remain stubbornly high relative to income, it noted. Business models have yet to be restructured on a sustainable basis, in particular, adapting to a lower and flatter yield curve. So, businesses models have yet to be restructured on a sustainable basis. I'd say that as translation as they haven't reduced their working capacity to adjust for the new situation. At the same time, the BIS noted banks are facing increasing competition from non-traditional players such as big tech, which are taking advantage of digital innovation. So there you go. That's quite interesting to see how this is just a play out, a combination of several different things. Obviously, they're pushing overseas. They're trying to expand into different sectors, a slowdown in the European economy, the stimulus brought on by the European Central Bank. And what we'll do is, let's have a quick look at the German economy just to get a feel for it. And this is from the Observatory of Economic Complexity, my favorite website at the moment. And I'm just having a look here. We can see what's the size of their economy. Well, their economic complexity is third in the world. Third in the world. Compare that to Australia. Their exports are $1.33 trillion, second in the world. Their imports, and think of that, second in the world, their exports. Their imports are 1.08, third in the world. And what do we have up there? So let's have a look at their exports. Cars, 12%. Vehicle parts. What do we have here? Heavy machinery. Wow, this is impressive. Just look at the complexity of this economy compared to Australia, and they've obviously are very susceptible to changes in global demand for their products. Now, who are they exporting to? We'll have a look. The trade balance, okay. Where are they exporting to? So, France, UK, Netherlands. So they're obviously exporting a significant amount to Europe. China's only 7.1%. Australia, we're not even 1%. So we're over there at what are we looking at? 0.7% export value. The US is 8%. China is 95 billion at 7%. So it's interesting to see just where their exports are going to. France is their biggest export partner. And then the UK. No wonder they want to keep them in the Union. No wonder they want to keep them in the Union. We have a look at their import partners. There we go. We've got Netherlands, United States 5%, China 10%, Hungary. Where is Russia here? They're not really ranking, aren't they? Turkey, South. That's surprising. I thought they would have. Oh no, sorry. Here we go. Russia, 1.8%. Import value of $19.9 billion. So yes, and here we go. South Africa. Where's Australia? Are we even here? There we go. 2.5 billion. So, I hope that gives you a little bit of an understanding of just their economy, what they're exporting and importing. I mean, this is a very big deal if Germany are having, Deutsche Bank is having these issues, and it's the main bank of their country, and it's all slowing down a little bit. So yes, I mean, how much of these, exports and imports that are moving all around Europe are the result of, this stimulus from the European Central Bank? How's it gonna keep going? It'll be interesting. It will be interesting to watch, guys. And I thought I'd just share this all with you. Let me know what you think. How do you think it would play out in an Australian perspective? Do you think our banks are susceptible to the same thing here in Australia? Do you think Deutsche is going to have a flow on to the Australian banks here? Guys, let me know what you think in the comments. Like, share, and subscribe. Ding the bell to see my daily updates, and I'll see you all again later. Bye for now.